Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
A little bit about what we do, and we'll open it up for questions in a moment. We have three basic cans of business at Know Your Options. We do managed trading and investing, and that if you want to trade through us and you're maybe looking for a little bit of advice before every trade, you can use our self-directed platform. It's powered by Options Express, but we have it set up to where if you want to get advice before a trade, you can give us a call, and we would be happy to do that for you. Once again, you have to have the account through our branch. Also, that's the self-directed brokerage with added value. And we are getting to the point where we're starting to send out recommendations for our self-directed clients. And not necessarily recommendations, but ideas of things that we're doing and that type of thing. So that's another service we offer self-directed clients. We also have managed money, and that if you're looking for someone to manage your longer-term portfolio, we do that as well. We're not afraid to use options. We believe in them very much so in terms of hedging. We also do business hedging. Like let's say that you are a dry cleaner, you're concerned about energy prices going up, or your costs are based upon perhaps maybe you're an international business and shipping costs are an issue to you and then currency risk is an issue to you. We do things with small businesses in terms of hedging them as well. For more information on what we do, visit our website, knowyouroptionsinc.com. Send me an email, m2saw@brokersexpress.com, or give us a call. Not to get too Billy Mays on here, but I've always wanted to say this, Steve. I'm sorry, I got to say it. Operators are standing by. So with that, I'm going to turn it back over to Steve. And once again, Steve, thank you for the privilege of getting to present on the ISE website. And folks, if you have questions, now is the time.
Mike, thanks again. I think the phones are jammed right now. So well, we'll see if we're going to lose our internet connection or our phone connection because the phones are so jammed.
Okay.
But anyway, Mike, always appreciate you coming to the ISE and spending a little time. Your experience is, I think that you sharing that experience is so important for all the attendees, and I've seen you present many, many times. You do a great job. I have a question, Mike, and this is a question that is asked of me very, very frequently when I'm giving a presentation on Straddles, Strangles, volatility. And it's, I'll see how you handle it. Question is, if I'm looking at two different equities, or in this case it could be currencies, should I buy a straddle on the currency pair or the equity, whatever it is, that's more volatile or less volatile? Is there any inherent advantage to trading straddles on companies or pairs where the volatility is higher or lower? What's your take on that?
Well, I would say is if you're in debate on that, create a sentiment on volatility. To quote the great Alex Jacobson, and I mean this very seriously, I think it's a great quote that he has. Volatility is high only if you think it's high, and volatility is low only if you think it's low. What I would do if you're in a debate over that, look at what the what do you believe the implied volatility is going to do in the future for those two pairs. If let's say you're debating between YUK and AUX, the yen and the Aussie dollar, take a look at both of them. And you're debating over doing a straddle on the yen or the Aussie dollar, look at both of them, and if you believe that volatility is going to hold steady on the yen and volatility is going to really go down on the Aussie dollar, then I would look at the yen, regardless of how the underlying has performed in terms of doing the straddle. With that being said, if you go with the more expensive straddle, you're taking on more premium risk. I think that would need to be adjusted by the size of your position. But with that, the way with which I would look at it is create a sentiment on where you believe the implied volatility itself is going to go on the individual pair itself. And whichever one you are the most bullish on or the least bearish on in terms of volatility itself, not the underlying, but of the volatility itself, I would go with that one when faced with that debate.
So to paraphrase, Mike, what you like to think about is what is the market expecting, what are you expecting, and then sort of compare and contrast and see which one makes more sense?
Yeah, that's exactly what I would do. Absolutely.
Yeah, that makes a lot of sense, guys. You know, just because volatility is high, and my colleague Alex Jacobson, you know, he says it so eloquently, you know, it all really depends on what you think. And, you know, volatility being high or low, that's really great for the media to talk about, but we're talking about the future, not what's happened in the past. And it's your view versus the market view. And I think that Mike said it so well that you got to decide, you know, just because the volatility is high in X, Y, Z, let's say it's the Australian, but, you know, you might see the volatility even higher in the yen, but you think that in the future the yen might even move more, then it would make sense. And vice versa. So you could just take it and turn it around, always look at the premiums. Let's take some more questions. Guys, just type in any questions you might have. Andrew has a question about technical indicators that you use, Mike. You know, what do you use, and why do you use the different indicators that you use?
Typically, I'm not much of a technician for the most part. I think that maybe 5 to 10% of my decisions are based upon, or it's probably maybe 5 to 10% of my decision in terms of making a trade. Typically, how I'll use the ISE FX options is typically for hedging long-term portfolios as a hedge. And with that, I'm more of a reactionary trader with these in terms of using a diagonal spread or a calendar spread, which is what we talked about in the last webinar. But with the way with which we use them is if it's creeping up to the short strike price, and I'm using a diagonal spread as an example, then I'll make a decision. I might look at the chart then, but it's still not a huge play. What I'm looking at for the most part is a longer-term view when doing this. I think I'm the world's only long-term, short-term buy-and-hold investment, short-term option trader, if that makes any sense. So typically I have more of a longer-term view, and the shorter-term side of it usually isn't much of an effect on me. Now, with this, if I were to do a neutral strategy on, let's say I was going to do a condor on the Aussie dollar, on the euro, or whatever, my indicators would be more along the lines of how am I going to get hurt the most? And when it's coming towards my short strike price, I would make an adjustment based upon risk management as opposed to the chart itself. I'm not very directional short-term of a trader. When I pick directions, I have more of a longer-term view, whether it's bullish or bearish. But when I am doing shorter-term stuff, I'm typically more of a neutral trader personally. And if the way with which I look at how is this going to hurt me, and I'm constantly paranoid about that in a good way. And well, maybe my wife says it's a bad way sometimes, but I constantly try and stay paranoid. That way, I'm respecting the market.
Good point.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.